There are moments, perhaps late at night, when a quiet unease settles in the heart of even the most diligent investor. You've followed the maps, built what you believe to be a fortress of diverse holdings, yet a whisper of doubt persists. Is this broad tapestry of investments truly protecting you, or is it merely a mirage, a collection of unrelated threads that offer no real strength against the storm? Many feel this quiet frustration, the weight of conflicting information, the anxiety that despite all efforts, a hidden vulnerability might lie beneath the surface of their meticulously constructed portfolios. It is a profound weariness born from the sincere desire for security, only to find the conventional path feels less like solid ground and more like shifting sand. We are often told to diversify, to spread our seeds widely, to never put all our eggs in one basket. This wisdom, passed down through generations, feels inherently right, like a fundamental truth. Yet, beyond the headlines, what's really driving the market? Is your diversified portfolio truly diversified, or have we, perhaps unwittingly, fallen into a pattern that offers the illusion of safety while harboring silent dangers? Benjamin Graham, the father of value investing, often spoke of the importance of understanding the businesses you own, not just their ticker symbols. He urged us to pierce through the veil of market noise and perceive the underlying value. This calls for an intimacy with truth, a willingness to deconstruct what is commonly accepted. Imagine, if you will, a vast garden. On the surface, it appears riotously diverse, 1,000 different plants, each in its own patch. But what if, beneath the soil, their roots are all entangled, drawing from the same shallow well, vulnerable to the same sudden drought? What if many are merely different varieties of the same species, providing no true resilience against a specific blight? This is the subtle deception embedded within many conventional approaches to diversification. We are not merely seeking to spread risk, but to understand the nature of that risk, and to truly fortify our financial lives against the unforeseen. We are uncovering the hidden truths behind wealth accumulation, not just adding more names to a list. Don't just invest, understand the why behind every decision. It's a journey toward genuine financial independence, a quiet rebellion against the superficial. In the moments ahead, we will gently peel back the layers of this conventional wisdom, exploring 3 insidious portfolio killers that often hide in plain sight, disguised as diversification. We will challenge the consensus, and in doing so, help you find your true edge. Are you prepared to look beyond the obvious, to feel the ground beneath your feet and discern its true stability? Our first silent assassin, often cloaked in the guise of prudence, is what we call the Diworsification Trap. This is where the very act of accumulating more assets paradoxically leads to less wealth, or at least a significant dilution of your potential. Many embrace the broad sweep of an index fund, believing it to be the ultimate shield. Yet, this widespread exposure can force you to own a multitude of mediocre or even overvalued companies simply because they reside within the index. This isn't true value diversification. It's a passive acceptance of the market's collective judgment, diluting the impact of truly exceptional performers. There's a deep-seated cognitive bias at play here, a comforting illusion of safety in numbers. We often confuse quantity with quality, driven by an overconfidence that more holdings inherently mean less risk. This looks like prudence, but often hides inadequate due diligence. It's a quiet whisper suggesting that if you own enough, you don't need to understand any single part deeply. But as Warren Buffett often reminds us, risk comes from not knowing what you're doing. This leads to a critical, introspective question. What is your portfolio's Achilles heel? Its concentration of mediocrity. True diversification isn't about owning a little bit of everything. It's about owning a thoughtfully chosen collection of fundamentally sound businesses whose underlying value you truly understand. It demands a rigorous assessment of individual asset quality, examining metrics like return on equity, debt levels, and the durability of their competitive moat. We must identify and prune the dead weight assets, those that offer little more than ballast without true growth or resilience. The illusion of set and forget is another dangerous facet of this trap. True diversification is not a one-time setup. It requires active, informed pruning, a continuous, data-driven re-evaluation of each holding. Like a careful gardener, you must decide which plants truly nourish your soil and which merely consume resources without yielding fruit. Would you rather cultivate a concentrated garden, rich with robust, well-tended plants, or a sprawling, untended field choked with mediocre weeds? The former, with its focused care and understanding, yields significantly more, allowing your wealth to flourish in a truly resilient way. Our second hidden threat, the Correlation Mirage, unveils a sobering truth. Many diversified portfolios fail precisely when their protection is most desperately needed. We often construct our portfolios assuming assets will move independently or in opposite directions. Yet, rigorous quantitative analysis of market crash, from the dot-com bust of 2000 to the global financial crisis of 2008 and the pandemic shock of 2020, reveals a critical pattern. During periods of extreme systemic stress, price. Asset correlations between stocks, bonds, real estate, and even commodities dramatically increase. It's as if a strong, unseen current pulls all ships in the same direction, regardless of their individual design, shattering the illusion of safety in numbers. This phenomenon is often exacerbated by a behavioral trap, normal market thinking. The normalcy bias, coupled with the availability heuristic, leads investors to extrapolate from periods of calm, low correlation, ignoring the critical, rare tail risks where traditional diversification offers little protection. We convince ourselves that what has been will continue to be, overlooking the potential for sudden, universal deluges. This looks like consistency, but it hides an inflexibility, a refusal to truly absorb new market data that challenges our comfortable assumptions. True diversification extends beyond merely diversifying asset classes. It demands diversification in systemic risk itself. This means analyzing your exposure to global macro factors, considering genuinely uncorrelated strategies and implementing robust downside protection, such as carefully chosen put options or substantial cash reserves. It requires stepping back and asking what truly moves independently when the world shudders. George Soros, with his theory of reflexivity, offers a profound insight into this market contagion. He explains how investor perceptions can create powerful, self-fulfilling prophecies. As fear or panic spreads, it can cause assets to move in lockstep, not because their underlying value has changed uniformly, but because collective perception forces them into shared descent. This shatters diversification's promise, as the very belief in a downturn reinforces its reality across seemingly disparate investments. Think of building an ark in the storm. A truly resilient portfolio is designed to withstand a universal flood, not just localized showers. It requires thinking beyond conventional asset classes to truly uncorrelated risk factors and strategies . Are your holdings merely different sails on the same ship, or have you built an independent vessel capable of navigating the roughest seas alone? Our third portfolio killer, often operating in the quiet shadows, is the silent dividend drain. This refers to the invisible erosion of your diversified wealth through fees and taxes, forces that compound in reverse, silently siphoning away your financial future. Consider a multi-decade wealth simulation. Seemingly small annual fees, perhaps just 0.5% versus 1.5% on a diversified portfolio, can lead to millions in lost wealth over decades. It's the insidious power of compounding, working against you, subtly diminishing the very growth you strive to achieve. These are not dramatic crashs, but a persistent, almost imperceptible leak. Beyond fees, the taxman's cut often goes underestimated. Many expect diversification to be inherently tax efficient, yet this is a misconception. Frequent rebalancing within a diversified portfolio, or holding certain assets in the wrong account types, can trigger unnecessary capital gains taxes. These liabilities significantly reduce your net returns, meaning the actual wealth that lands in your hands is far less than what appears on paper. It's a quiet subtraction, often overlooked, that can profoundly impact your long-term accumulation. Then there's the diversification premium, often touted by advisors. But does the value offered truly justify the advisory fees and fund expense ratios? A forensic accounting approach is needed. You must calculate your total cost basis, compare your net performance against a low-cost, broadly diversified index, and then honestly assess if the diversification provided truly outweighs the performance drag. This requires a willingness to challenge, to look beyond the surface. This pursuit of true cost transparency can be unsettling. The mild stress, the cortisol that rises when questioning a trusted financial advisor or dissecting complex fund documents, can lead many to avoid this crucial due diligence. This discomfort, however slight, hinders empowered, data-driven decision-making, allowing these invisible drains to persist. Think of your portfolio as a bucket. Diversification is supposed to strengthen it, to make it more robust. But hidden fees and taxes are like tiny, unnoticed holes that constantly drain water. You keep pouring in your efforts, your capital, yet the bucket never truly fills up as it should, because the erosion is continuous, silent, and often unacknowledged. Are you truly seeing all the ways your wealth is being siphoned away? Our fourth portfolio killer is the paradox of choice, a quiet torment where an abundance of options leads not to freedom, but to analysis paralysis and, ultimately, poor decisions. Modern portfolio theory, with its elegant efficient frontier, often assumes rational investors with perfect information. Yet, in the real world, this theoretical perfection frequently translates into portfolios that are overly complex, difficult to implement, and profoundly challenging to maintain emotionally. The pursuit of an idealized mathematical solution can disconnect us from the human reality of investing. This complexity is amplified by potent cognitive factors, the fear of missing out, or FOMO, and the overchoice bias. These forces compel investors to constantly add new assets methods or strategies, creating not a cohesive plan, but an incoherent mosaic. What appears to be decisive action is often a frantic attempt to cover all bases, hiding inadequate due diligence and a lack of true strategic coherence. It's a restless energy, always seeking the next thing, rather than deeply understanding the few. To combat this paralysis, we can embrace a behavioral finance technique rooted in simplicity. First, define your core investment philosophy with clarity. What truly resonates with your understanding of value and growth? Second, establish clear, non-negotiable criteria for asset selection. What must a business possess to earn a place in your portfolio? And finally, limit your investable universe to a manageable, high-conviction list. This isn't about restriction, it's about focus power. The story of John Bogle and the rise of index investing reveals the profound power of such elegant simplicity. His approach, radically straightforward and truly diversified without being **diversified, demonstrated how a clear, low-cost strategy can often outperform the most intricate, high-fee endeavors over the long term. It's a testament to the wisdom found in restraint. Consider the overwhelming detailed map of all possible investments against the simple, reliable compass of core investment principles. True mastery isn't about perfectly charting every path on the map. It's about having that clear directional guide, that inner compass for every decision. Do you feel overwhelmed by the sheer volume of choices, or are you guided by a quiet, unwavering principle? Our final insight brings us to true risk intelligence, a shift beyond blind diversification towards strategic portfolio fortification. The hidden truth, often obscured, is that diversification is a symptom, not a cure, for risk. It shatters the expectation that spreading your investments *eliminates *risk. Instead, it merely *manages *specific types of risk, like the unique challenges faced by a single company or industry. But it does not address systemic risks, where the entire market moves together, nor does it account for valuation risks, where assets are simply priced too high, or behavioral risks, where our own emotions sabotage our best intentions. True risk management demands a deeper, more discerning analysis. Many seeking strategic wealth building make a fatal mistake. They build their castles on a financial forecast written in sand on a windy beach. They rely on the fleeting whispers of short-term market noise or generic predictions for their long-term strategic decisions. This leads to impulsive, reactive diversification, a constant chasing of trends, rather than a principled, proactive approach rooted in fundamental analysis. It's like trying to navigate a vast ocean by watching only the ripples on the surface instead of consulting the deep currents and the stars. To uncover genuine portfolio protection, we turn to a three-step value investing technique. First, focus on intrinsic value and a margin of safety, as Benjamin Graham taught us, selecting high-quality assets priced below their true worth. Second, analyze business model resilience and competitive moats, drawing from Warren Buffett's insights to understand what truly protects a company from rivals. Third, implement strategic asset allocation based on a thorough macroeconomic analysis and thoughtful scenario planning, preparing for various future landscapes. Yet, informed decision-making often stalls when touching the unconfessed lack of transparent, data-backed frameworks for qualitative company analysis. It is difficult to truly assess qualitative factors like management quality, enduring competitive advantages, and dynamic industry shifts. These are crucial for real risk management, yet they are often left out of purely quantitative diversification models, leaving a crucial gap in our understanding and protection. Consider your portfolio construction not as building a simple fence which merely delineates space. Instead, envision yourself as a financial architect designing a resilient fortress. This demands understanding structural integrity, identifying potential weak points, and anticipating external threats for long-term endurance. Are you merely putting up a fence, or are you building a fortress with true, enduring strength? We have journeyed together, peering beneath the comfortable surface of conventional wisdom to uncover three insidious portfolio killers that often lurk unseen. We saw how the Diworsification Trap can dilute your wealth, turning a broad collection of assets into a field of mediocrity rather than a garden of robust growth. We then confronted the Correlation Mirage, revealing how your seemingly diversified portfolio can fail precisely when you need it most, as assets move in lockstep during systemic shocks. Finally, we exposed the silent dividend drain, the invisible erosion of your hard-earned wealth through persistent, compounding fees and unnoticed tax liabilities. These are not mere academic concepts, they are forces that touch the very fabric of your financial security, often leading to that quiet unease, that sense of frustration when diligent effort doesn't yield expected fruit. The truth we've uncovered is this: true portfolio protection and sustainable wealth do not emerge from blindly spreading your baits. They ripen from a deep understanding, from strategic insight, and from the courage to challenge the consensus. It is a path that demands critical thinking, rigorous data analysis, and an unwavering commitment to time-tested value investing investing principles. This is not about chasing fleeting trends, it is about building enduring financial strength, brick by carefully chosen brick. Now, the invitation is extended to you. Empower yourself. Take up the mantle of a discerning investor, not merely a participant. Examine your own holdings with fresh eyes, asking the difficult questions. Where are the hidden concentrations of mediocrity in your portfolio? How truly diversified are you against systemic risk? Are your fees and taxes silently draining your potential, or have you plugged those leaks? Your path to financial independence is forged in these moments of honest introspection and data-driven action. As Warren Buffett wisely reminds us, risk comes from not knowing what you're doing. Your wealth journey is not about blind adherence to dogma. It is about informed mastery, about truly understanding the why behind every decision, every allocation. It is about moving from a state of quiet anxiety to one of profound clarity and control. What will you do now that you have seen these truths to fortify your own financial fortress?